Hello and welcome back to Green Disruptors, Scaling the Future. I'm your host, Kjar, and today I'm joined by Nicholas Rohleder, co-founder of Climate Commodities, calling in from Dallas, Texas. In this episode, Nicholas dives into how Climate Commodities operates as a holding company with kind of a barbell approach, developing greenfield climate infrastructure, acquiring brownfield assets at the intersection of climate and national security, and building insurance-linked solutions for the sector. We'll explore real-world examples of converting hazardous waste into critical materials for steel, ceramics, semiconductors, and discuss the major challenges around feedstock quality, capital markets, and regulatory volatility. So there's a lot being covered today. Nicholas has spent years in energy finance and continues teaching commodities finance at UPenn. So you'll want to hear his perspective into turning waste into value at scale. Let's do this. Hello and welcome back to another episode of Green Disruptors. Today I've got Nicholas Rohleder on with me. He is the co-founder of Climate Commodities. How's it going, Nick?
Good. Thank you for having me.
Yeah, it's a pleasure to have you on. And tell us where you are in the world.
So I'm actually calling in from Dallas, Texas right now. Enjoying that one brief period of time during the year where the weather is manageable here.
Is it like a 4-week window?
Yeah, well, we got through like the, like 60 to 70 limited wind, and now we're in like the, 80, and then the mosquitoes are here, so it's...
Yep, that's funny. Okay, so tell us a little bit about Climate Commodities, and then maybe like your personal background and what led you to becoming a co-founder.
Yeah, happy to do so. And so I think, my natural resources journey started really as a kid, kind of at the dinner table. And so I grew up, and most of my family had been in the energy and natural resource industry. So as a child, like hearing them talk about it. And then as a teenager, every time I didn't have football or soccer practice, I worked manual labor jobs in that industry. So quite the introduction to it, and was fortunate enough to catch the bug for energy, natural resources, alternative energy towards the end of it. Ended up going to school for it. So I went to Columbia University, did graduate school at UPenn and Oxford, and then went into the finance industry specific to this underlying sector. And so I spent most of my career in distressed debt and project finance, specific to kind of energy, specifically via power, fuels, and midstream metals and mining. And so, when I was doing that, one thing that was kind of interesting that and my co-founder and I really observed, we met through this period, is that, we're working at funds. And so like one of the big things when you work at a fund, you get in the situation where, you have to scale your assets under management, right? Whereas like some of these really impactful areas of the climate ecosystem across, let's call those power, fuels, midstream metals and mining, as I mentioned, some of the most impactful things you can do are $1 to $5 million investments in earlier stage projects where you can gain control and really have a say in how the resources and the development organization are built from the ground up, given that a lot of these projects and programs fail in the organizational design phase. The idea there was to set up a business in operating company wrapping paper to engage in this activity on a barbell basis. So supporting greenfield infrastructure development projects and then buying existing assets and businesses within a predetermined criteria along those same sectoral areas. So that's sort of how we got the idea for this. Is we saw this gap, right? Whereas if you're a ready to go project, you need a couple $100 million. There's an existing ecosystem for you.
Right.
In this middle area, if you're a project originator with a team, 1, 2, 3 people, or you're existing business owner seeking to sell your business. In a lot of cases in both of those areas, there's not a fully functional ecosystem for that project originator or the business in the event that it is a true commodity asset, right? In the event it's not super straightforward, it's taking commodity risk, there's price tools you have to do. It's not in that bucket that most traditional private equity firms would look for, where it's a vanilla widget sales business, a lot of operating history. And so those are the two things that we saw a gap when we set up a business to address it. I think that, outside of that, where we've been increasingly focused on is kind of at the intersection of climate and national security. I, as an adjunct professor, teach a commodities finance and a climate tech finance course at UPenn. And I'm a fellow at the U.S. National Security Institute. Has been something that is increasingly of interest to us, and I think that given the present situation, a huge focus area for us.
So help me understand a little bit better, like what is the business model? Like how, explain it to me a little bit more, sorry.
So we effectively, so take two sides of it. Think like the if you look at our business, there's kind of three legs to the stools, right? The
Okay.
development with a barbell approach. So we develop greenfield infrastructure projects, and we purchase brownfield assets via tied to the defense industrial base, specifically at that intersection of climate and national security that I mentioned. And then we own and invest in via insurance linked businesses that serve this sector, primarily in the areas of the construction related risks and technology related risks specifically. And so that is the breadth of what we do.
So does that third component, is that kind of where you can help fund some of these mid-level projects?
I think that, the way we've set this up is really as a holding company. And so traditional structure, we can interact with a pension fund, an insurance company, an endowment, but also a private equity sponsor or an infrastructure fund, for example. And so I think that one thing that was really important in doing this, just watching how my parents orchestrate this, is that having flexibility of focus and capital is really, really important. And I think that that's something that a lot of entrepreneurs in the space have troubles with, because you look at the present situation, greenfield development is increasingly challenging. But valuations have come off, and there's increasingly an ecosystem of elderly founders in particular, especially in these commodity industries, that are seeking an off ramp or an exit. And so from our perspective, even though the greenfield is more challenging, opportunity arose in the brownfield side. So the importance of that barbell is huge. And I think the insurance situation came to us just around the fact that we do this for our own projects. We do this externally. And, that industry is going through, especially related to industrial sectors, the unemployment rate. Mostly when they think insurance, they think about, my kid is going to go work at Northwestern Mutual, cold call all my friends for wealth management or life insurance. Whereas the actual risk-bearing insurance, the more statistical, the profession, high skill, not low skill professions, within there, the unemployment rate is actually very, very low, and the replacement rate of elderly employees is also very low. And so, there's interesting opportunities within that area specific to the sectors that we focus on. We find that process knowledge on the development side is transferable to the executing on this insurance strategy as well.
Okay. So can you give us maybe some real world examples, and you can pick any three of the stools to talk about, but what's kind of a recent project that you've worked on and maybe the impact that it's having?
Yeah, so I think that right now a big focus of ours is within just as a note on this. I have to name redact some of this. So I'm going to be so a big focus of ours presently is in the waste to critical mineral value sector. And so what we've seen, generally speaking, is that if you take, obviously there's a lot of discussion around critical minerals in the context of the West, EU, US, UK, and a lot of this is around how are we going to get this supply? Are we going to bring on new mines? Are we going to friendshore? And I think that what we think is that there's actually a really interesting case and the suite of technologies to extract these critical minerals from waste, specifically hazardous waste in our case. And so one thing that we've been working through is a project that takes hazardous waste and converts it to a usable product that is used in the steel, ceramics, and semiconductor industries. And so, the big situation and challenge there, I think from an impactful perspective, this specific commodity has not been produced in the U.S. since the late 90s.
I was unaware that was a possibility, so...
It's interesting. I think that is one of the most underinvested and underappreciated areas of this ecosystem, because when you think about investing in a mine, you've got 10 plus years to get it developed, permitted, and this is assuming you can raise the capital, and then you've got which is insane. Extremely challenging, and I think one of the big issues there, and we published on this before, is that just the metals and mining capital market is extremely fragmented as well. And so what we see that's kind of interesting is that in these waste to value areas, in a lot of cases, you get paid what's called a tipping fee to take the waste in. And so you have an input revenue stream that starts to lower the risk on the output side specifically, versus if you invest in a traditional mine, you're
It's
hoping
just
that,
giant cost up front and that's it.
and it comes online during the appropriate part of the commodity cycle for the output
Yeah.
product. And so what we have found, what we're in the process of navigating with this is, how do you take what is historically a commodity cyclical asset and then put it in infrastructure wrapping paper? And so that is something that with really more fixed income proxy type of return streams and earning streams. And so this is an activity that we're heavily focused on. We've got a live program projects we're actively developing in this area and really seeking to do more on this, because I think that, when we first started down this path, we had an idea that this is workable, but now, in being in execution phase, like we have a pretty high level of conviction that this is repeatable and scalable and quite impactful as a pathway to achieve these critical mineral supplies on a timeline that is tighter than bringing on new mines.
That's so interesting. So, from a curiosity perspective, just with me, like you're doing a huge favor basically to these companies. They need to get rid of this hazardous waste. What kinds of companies and industries are you getting them from? Is it like medical waste? Is it all across the board?
It's a broad mix. I think that, as I mentioned prior, we work with the independent technology companies and the operating businesses to source this. And so it's really a mix. I mean, I think that right now, the two industries that we're dealing the most with are the semiconductor industry and then the traditional waste industry. Most of our background is kind of living within the technology supply chain specifically. And I think that, you find, so it's interesting. If you look at that value chain, people think of, waste management and public services like trash companies historically. Like if we went around town and we surveyed people and said, what do you think about that company? They would say trash company. Whereas if you listen to an earnings transcript or you listen to one of these CEOs talk, given the way the circular economy is developing, they'll characterize themselves as integrated environmental service and raw material suppliers. And so that narrative has changed quite substantially. And I think that, what we've really trying to focus on is being the complementary, not adversarial to that value chain in particular, just because
absolutely.
Our business is de-risking infrastructure and technology, not be an integrated waste logistics company. And so, if you think about yourself as, you don't want to compete with a company like that, right? Like you want to be a solution to help them achieve some of their landfill diversion and related aims. And so that's how we've approached that in particular. But I think that ecosystem is far more important to some of this value chain than a lot of people in this sector appreciate.
Yeah. Well, it goes back to what you said about comparing it to starting a mine. Like the infrastructure with these businesses is already in place. So if you can come and find a way for them to make more profits on it, like it does seem very scalable. So tell me, kind of speaking of scaling, so what is the kind of core area of growth that you're focusing on right now?
To go back to that,
same thing.
To that same point, and it's interesting. I think that right now, there's an important point to make on the area of like comparing a mine to this, because if you look at a mine, the resource quality is the most critical attribute, right? And then in this area, the input waste quality is the most important characteristic, right? And so I think that it's actually not too dissimilar if you think about that lens of like the input quality, because I think a lot of people in the waste to value ecosystem get focused on the output, whereas the risks are in the feedstock logistics, quality assurance, and control area. And shifting that to where we think we can grow, and we're focused on a mix of finding new projects within this value chain and development companies to partner with. And then the other side is buying existing businesses that are serving some of these value chains. And I think with a specific focus on the quality of input resource in particular, and looking at, really where like our skill sets are really twofold, right? Like something that fits well for us. We have project development capabilities, but we also have the significant commodity price risk management capabilities. And so I think whether that is through just direct instruments that are available to a company acting in this space, or through proprietary mechanisms we've developed through our insurance arm. And so, I think from our perspective, we're probably 60% focused on the acquisition of existing businesses that serve these value chains, and then 40% focused on the finding new greenfield opportunities that during this this, let's call it trough here of activity, we can start to build a really good base. So when things revert, we're in a position to really execute and roll out the program. And so again, that barbell, the structure and action.
Yeah. So what's maybe like the most challenging? Let's go to the side of finding new projects. What's kind of one of the biggest challenges you're facing in finding those and seeing if they're a good fit and all of that?
I think it's really twofold, right? Like if I'll take to one, the is a function of the issues in the capital market, and then one is a function of issues in the regulatory environment. And so I think on the capital market side, if you have a look at the life cycle of a technology hardware company, it's just funding, right? From in a lab, we got an idea to we have something in the field. One of the most challenging areas of funding is that we need to go from lab or small pilot to demonstration to first commercial, which is generally characterized as first of a kind or folk, the projects. And so I think that there's been fragmentation in this area of the capital market for quite some time. And as a development business, you have to pick very carefully what are the scale up boundaries, and you partner with a company at this stage, and really what sectors and technologies do you really understand, and at what stage of development do some of these supplementary risk management tools become available. And so I think one area there is that the ecosystem it's developing, but it's underdeveloped. And it was reliant and still is reliant on the policy support that was hugely available within the last administration. That's now been communicated to be redacted. And then I think the simultaneous to this, you have a regulatory environment that has been a bit volatile in the last couple of months, to say the least. And then, and then irrespective of your politics, there's it's volatile and it's hard to price anything given how markets are moving around, right? So I think the challenge you really want to run into there is twofold. One, even though the broad tariffs have been paused, the tariffs on China are still in effect. And I think that one thing, especially looking at the power side of the value chain, and then on a supplementary basis, the midstream metals and mining side, just to touch on two things here. On the power side, and this extends to the entire economy. There's actually a great the piece this morning on iPhone components, for example. The raw materials and the intermediate componentry all comes from China. And I think that people underestimate the degree to which our economies are intertwined from a raw materials and componentry perspective. And that is really a sizable risk to costing, to implementation, to timelines, to all the core tenets of whether it's in practice or academically, you'd study if you've got into project management and development. From a project delivery perspective, the risk has been heightened substantially in the supply chain delivery parts of the chain here, irrespective of technology, just given that dependence. And I think that to be frank, is really what has led us to focus on some of these brownfield opportunities where there is expansion, because the other area in the metals and mining value chain specifically is that the one thing that the U.S. did differently than Europe in some of these value chains is that we exported the process knowledge to China too. So now, ironically, we are dependent upon process knowledge for some of this as well. But we actually spent decades building up the process knowledge, and now we've decided we want it back, which is not an overnight switch. And so I think one thing that we've focused on, just to give you a precise example of where we see this in action, is that if you have an existing business that is executing this activity of production, commodity conversion successfully, and you're going to do an expansion project, if it's, a couple towns away, halfway across the country, whatever it is, or even next door, you can export process knowledge to grow without bringing it in from what's been designated as an adversarial jurisdiction. And so I think that some of these little things are underappreciated that we're really hyper focused on.
So is there anybody out there doing anything similar to you? Like, do you feel like you're in a unique space?
I think that, what really differentiates us as a development company and as an investor, owner, operator of these insurance platforms is that we try to we know what we're good at and we know what we're not good at. And I think that, what we are gonna is managing the commodity cyclical and commodity exposed assets that serve these various value chains. And so, from our perspective, we look at like where we can add value the outside of just being a project development company. A lot of it is around this kind of structuring, given that we have a background in, because the two things you learn, like my co-founder's background is in physical trading, mine is in distressed debt. So when you see a lot of offtake and feedstock structures that achieve bankability, and then a lot of, frankly, just things that have gone horribly wrong, that intersection is a recipe for the rather creative structures that I think we approach some of these areas a bit differently than, like, to my point about taking something like, critical minerals and trying to reframe it in the lens of infrastructure. Like, that's the kind of stuff that we try to really foster internally to think like, well, on the one hand, I think it's a different approach. On the other hand, it's attracting and retaining the smart people. It's getting them involved in a challenge. That I think that they'll get a variety of technical skills that'll be, hopefully they stay with us or they leave us or transferable, right? So I think that, that's really where I think we differentiate. Most people that we talk to in this area, they don't touch assets with the same characteristics because they develop deal structuring capabilities internally, not necessarily commodity price risk management, and cost project implementation resources. Like, that's the difference between an operating business and really like an asset management fund company. And that's kind of what we sought to specifically plant a flag in when we left the asset management industry.
Yeah. So how's it going as far as like you're doing things in a different way and asking people to kind of rethink some systems? So how hard has that been to kind of help people understand the value of what you're doing and just kind of that education piece?
I mean, the one thing I will say, like one of the reasons I started teaching this class as an adjunct professor is precisely because of this issue. It was extremely challenging, and I think one thing that like doing the teaching thing, it really forces you to reframe and think like, okay, I have to go base level concept, and almost like math, like building blocks.
Yeah.
As you
If you don't know
something,
your addition, there's no way you're gonna get the yeah.
And that's something that I think most people, and I'm guilty of this as well. Like, if you work in one business or sector, you do something specifically, you're in it every day. A lot of times when you chat to someone, you assume they have familiarity with the discipline.
Yeah.
And that creates a lot of issue when you're trying to really educate, especially trying to get someone to invest in something that you're doing. And so I think it's very challenging at first. Because we've been at this. If you look at like the period that this is the second business that I've done. My period of time as an entrepreneur has spent COVID, inflation, the Ukraine conflict, tariffs. So it's
Welcome to business.
Yeah, I mean, look, any entrepreneurial journey, it's not really like properly an entrepreneurial journey unless it's highly volatile. But I think that
it has been insane. Like, that's totally fair.
Yeah, I mean, but I think that really like what I think has made this work, and my co-founder and I have really stuck to this. I think that one thing, because consistency is the most important thing, right? Like, how you treat people and communicate with people when times are bad is where all the character and these issues get aired out. I think from our view, like the way to get someone to trust you in an area that is maybe not super familiar to them is just to be the precise, the holistic, and then fully transparent as to what it is you're trying to achieve, how it is you're going to achieve it, the process underlying that, and really work from like, here's like the way we do things is we go like, what's the worst case scenario, and then work up and so I think that like the narrative and illustrative experience of kind of looking at things that we particularly get involved and invest in is useful for partners across the board. And so I think that coupled with the transparency, I would say radical transparency, is the only way doing something like this works.
Yeah, I think you're absolutely right. So is there, I don't know, if somebody wants to find you or get in touch with you, what's the best way they can do that?
It's funny. I am not the best with social media, but I am quite active on LinkedIn. So that's probably the best way to contact me, is to connect me on LinkedIn.
Okay. All right. Is there anything that you would like to cover before we wrap up here?
I think I think we covered everything. I think one thing I always talk about, and part of why I teach this class, is even though there's, a lot of issue in this space, there's a lot of uncertainty. The down times, the distress times, are the best times to start a business. And I think that I always try to emphasize that at the end of any discussion like this, just if somebody who's on the verge of entrepreneurship happens to be listening.
Well, and it's because there's a lot of problems that need to be solved, and solving a problem is basically essentially the start to any business. So that makes sense to me.
And I think I always joke, like, 1 year of working in a volatile entrepreneurial environment is equivalent to 5 or 6 years of working in normal
It's an
day job.
education, yeah. I think you're absolutely right about that too. So it's very valuable, and the time that you put into it and the knowledge that you gain is an investment that pays off usually.
Absolutely.
Okay. Well, thank you again for coming on. It's been a pleasure, and hopefully this could help with that education piece in getting out your mission. So thanks again.
Thank you so much for having me.
All right, thanks for tuning in, and thanks, Nicholas, again for joining us and telling us about Climate Commodities. We covered their barbell model, which takes greenfield project development, brownfield acquisitions tied to national security and insurance-linked platforms. Plus, we did a deep dive into waste to critical material infrastructure and the hurdles in capital markets and regulations. Thanks for your insights on how and why to invest in the middle of climate infrastructure. If you enjoyed this episode, please subscribe, leave a review, and share it with anyone interested in climate finance or resource innovation. I'm Megan Kjar. Stay curious, keep solving big problems, and I'll see you next time on Green Disruptors.